But Dylan, why don't you give us just like how do you differentiate between, as you mentioned, trading and investing as it relates to the wheel here?
Yeah, absolutely. So, Ben mentioned I talk to traders more than really anybody else here at PeakBot, and I had to talk a couple people off the ledge this week, and more than a few people, right? And the conversation that I go about having with these individuals. First off, I don't get a call unless they're trading. Most of the time, they're trading a very risky stock. They got to sign their shares. They have a relatively large unrealized loss on their account. Okay, hundreds of dollars, maybe even thousands of dollars, depending on their portfolio size, and they start panicking, right? A lot of these conversations happen with traders who are relatively new to PeakBot, okay? Either on their 2 week free trial, because we have one, or new to their subscription. Now, the conversation they come to me and having is, okay, well, I'm freaking out. This algorithm, I thought it was going to be making me money, and I'm just losing money right now. And then, really, what I like to do is walk them through a couple things. I ask them a couple questions. I go, first of all, the real idea here, the wheel strategy, which we didn't reinvent the wheel, we just automated it, pun intended, right? This strategy's been around for decades. It's time tested. Wall Street, hedge funds, retail traders have been trading this strategy for a very long time. And what's known is that it's not a quick flip. This is a long term, slow growth investment strategy. We're collecting premium. I like to say as a form of passive income. Others might say that there's no such thing as passive income, but we can have that argument on another call. But the point is, we want to make you 0.5% to 1% a week. Okay. And in premium, and that's taking into consideration losses. With premium, we want to make you, and the chart spells this out for you, between 0.25% and 2 or 3% in premium. Okay. So what people freak out is that they'll be trading stocks like Marathon or Rivian or Riot, and they get assigned the shares. These are very volatile stocks. We tell you that because at the top of the watch list, it says very high risk. And you can see the distance of the spread compared to the cost of the stock. It's all over the place. And so the first question I ask them is, do you know anything about this stock? Right. And I have humbled a few people. I say, hey, do you know anything about Marathon Digital Holdings? They go, no. I go, well, why are you trading it? And I'm not trying to be a jerk, but I asked, why are you trading it? They go, well, I saw it at the top of the watch list. It's paying the highest premium. I was in. I was sold. I go, well, let's take into consideration a few things. If it's at the top of the watch list, sure, it has the highest reward, but it also brings the highest risk, like anything else, right? It's sometimes it's too good to be true. You guys know my range, 0.5% to 1.5% on that watch list. If it's paying more than 1.5% in a given week, my estimation, not the world's, it's getting a little too volatile. So these people will call me and say, I'm down $1,000 on my Marathon position. What's going on? Can I cancel my subscription? I want to close my account. And I tell them, look, here's you got a couple choices. You bulldozed through every red flag and said, okay, I'm only going to trade one or two stocks. I'm going to choose the most risky ones. I'm not going to diversify, and I'm going to just collect my highest premium. Well, those premiums can be wiped out by these unrealized losses, but there's a couple things. A, it's unrealized. You still own the shares. And some of these people, they're newer to trading or investing. They don't even realize they still have the asset. I go, look at your account. You still own these shares, and you're going to collect another round of rent or premium this week, and you're going to continue to do that regardless every single week. So the idea is, if you can collect enough rent throughout the year, right? This is not a strategy that you do for 2 or 3 weeks. This is a strategy that you do for 2 or 3 years or 20 or 30 years, right? Because the accumulation of everything, we're going to collect enough rent to eventually outweigh your losses along the way. And the one individual I spoke with owns rental properties, short-term rental properties. I go, oh, you just walked right into my hand here. I go, let me ask you a question. Would you rather rent to a family of three or the rowdy college kids, right? And his answer happened to be whoever's going to pay double. I go, okay, then. Well, you've said it. You're a gambler. You like rolling the dice, and that's why you're trading Marathon, and that's why you're down $1,000 right now because you chose danger when you woke up this morning, right? And so I asked him. I said, hey, when the college kids come into your rental property and they bang everything up, and there's holes in your wall, and your dishwasher's foaming and broken, I go, what do? He goes, I fix it and get another round in there next week. I go, exactly. So you can't quit now. Fix it and keep going. Keep collecting rent, right? So you're either going to stay the path because you believe enough in the stock that you're trading and say, hey, I'm good enough to earn the premium on this week to week. Or you're going to say, I'm going to cut bait, I'm going to simmer down, and I'm going to go on stocks that I feel better about, the Amazons, the Verizons, the Googles of the world, as an example, right? I asked them, I said, hey, if you were down $1,000, but this happened to be Amazon instead of Marathon or Riot, would you be panicking and calling me? I go, absolutely not. I go, why? They said, well, because I know the stock's going to go back up. I go, then you just answered it yourself. So when you're at the top of that watch list and you see a lot of red, very high risk, you're choosing, in my opinion, to be a trader. And that's okay. But if you're going to be a trader and take risks, stick to it. See it through. Stick to the plan. Go for a whole 6 months, for a year. Even these very volatile stocks, they might be paying 1.5%, 2% a week in premium. If you made 2%, right? Let's just take Zim or even Marathon's paying almost 3%. But let's say Zim pays an average of 2%. I'm just going to round up 2%. all year. That's 104% return in premium, right? Our goal here is to make you 20%, 30%, 40%. And there's outliers, of course, on both sides. But if you can tell yourself, all right, if I'm going to make over 100% in premium this year, do I believe enough in this stock not to kill my value 70%, 80%? If you're still not sure if that stock that you're trading isn't going to wipe out all your premiums throughout the year, get off of it. Go somewhere else. But if you want to be, and that's you being a trader, but you can't quit, right? When the going gets tough, you can't just walk out. The other side of it is being an investor. Ben, scroll down a little bit. Go down to the bottom of this watch list where we're seeing 0.5%, all things like that. My father, you guys are sick of me saying this at this point, but my dad trades Amazon, Verizon, and Google to the day he dies. He doesn't touch it. He doesn't look at it. Why? Because he knows that those companies are going to go be okay in the long run, right? At least that's the mentality to have. So he's acting more as an investor. If you're at the top of this watch list, you're acting more like a trader. Both are okay, but you got to stick to it. If you just bow out when you're down $1,000, that makes you a loser. I only tell people who I'm very close with that they're a loser if they bow out right now. But it is true.
It's
So
it's a long-term play.
it's a
And
long-term play.
Dylan,
And
I'm gonna pull up your chart if you don't mind
please,
that we
yeah,
shared on Twitter to just
yeah,
hammer Dylan's point home here. We did an analysis on all of Dylan's wheel trades in 2023. Now we started trading the wheel at towards the end of January, so we didn't get a full year because we didn't have the wheel available for the full year. But I mean, if you take a look at this chart, it took a couple of months for Dylan to get going here, right?
yeah,
And that's the power of compounding. But um, you know, you can see that there are going to be losses. There are going to be losses along the way, and we see that in um, September, October, into November, this time frame when the market was declining. Well, so was Dylan's portfolio, but he stuck with it. And then as soon as the market turned around, he started to see some steady growth back up. So there will be wins, there will be losses. I think Dylan, you made a good point. And guys, hit that like button if you thought Dylan's analogy was good. And explain the difference between being an investor and being a trader with PeakBot. Um, very, very well, Dylan. I thought that was great. And I
thank
think
you.
your chart is a great visual to show people that, hey, this is, a long-term play. Like you stuck with it for a year. We actually did a deeper analysis. Maybe we'll go over it on another show. We did a deeper analysis of Dylan's trades. I think you traded like something like 44 different tickers over the
Yeah,
course of the year. And your top earner was Carvana. And if we go back to the watch list, Carvana is and has been at the top of this watch list
yep.
basically the whole year. You can see it's ranked as a high risk level right now. For the most part of the year, it was very high risk level. But to Dylan's point, if you're confident, and Dylan, I think you mentioned that you were confident in Carvana stock. If you're confident that that stock long term is going to be okay, if you stick with it, I mean, Dylan, I think it accounted for a little over a quarter of your earnings here.
I
Uh,
think more than that, quite
yeah,
honestly. I think a significant amount more than that. And that kind of speaks to you can live in both lanes. I acted
mhm,
as a trader and an investor last year, right? I have certain stuff, and that's the beauty of diversifying your portfolio. The average account size for PeakBot, our average trader has between $10,000, $15,000. When people sign up and you only get 2 grand going, although that is technically the minimum, you're not giving yourself much room to breathe. You're putting all your eggs in one basket. I'm going to go on some safe stocks, some mid tier, and I'm going to roll the dice on a few. And that allows me to do both. Let me tell you, July last year, we were ready to sell this thing to millions of people. I was up 65%, this idiot, right? But reality strikes. I lost half my shirt on the last 3, 4 months of the year, but I still finished at 31% on the year, which is better than 95% of retail traders. And I did it with my hands in my pocket and I did it fully automated, right? I picked the stocks, our bots did the rest. So, um, Ben, look, I hope that resonates with people. We're here to
yeah,
automate, we're here to make it easy, but the, don't we're here to save time and eliminate emotion. Don't manage this. Manage it, pick your stocks, feel good about it, but don't overmanage. When the team's down at halftime, the coach doesn't go in and freak out. They say, hey, if we stick to our plan, if we do what we've done in practice all year and stick to it, we're going to come out, we're going to win this game. It's the same mentality here. So I'll hand it
yep.
to you and we can take a look at some charts.
Yeah. Let's get into some charts.